Well, good afternoon, everyone, or in fact, it could be good morning or good evening for those around our region. Welcome to Deloitte's Dbriefs tax webcast series in Asia Pacific. Our webcast today is part of our corporate income tax series and is titled Global Minimum Tax Pillar 2 with Oracle's TRCS, the how and what. My name is Piers Valab. I'm a tax technology consulting partner based in Deloitte, Singapore. I also lead our Deloitte Regional Compliance Centre, also headquartered here in Singapore as well. I have the pleasure of hosting today's webcast. I've got three speakers with me today, Li Mei Liao, Madhav Savasararo, and Kenneth Kramer. Li Mei is an international tax partner. Madhav is a tax director in our AP Tax Technology Consulting team. They're all based in Deloitte, Singapore. Kenneth, our guest speaker, is a tax senior principal product manager from Oracle and is based in the US. So it's a pretty, not a very great hour for you, Kenneth, in terms of this call, but we hope to get through this whole hour. Just to get through some admin matters, you may access our bios on left-hand side of the screen. And I'd like to take also a moment to outline some of the features of our webcast console. Firstly, all users will be on listen-only mode. If you have any content-related questions, you can submit them anytime in our Q&A box at the bottom right of your screen. We'll do our best to respond to the questions during the presentation today. Second, all PC users can minimize or maximize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen if you want to, and download today's slides and related publications. You can go to the downloads and links box. On the other hand, mobile users can view the slides and answer the survey on the screen. Thirdly, if you require an attendance record for this event, you'll receive an automated CPE certificate after watching for 50 minutes. Can we move to the next slide, please? So let's just talk a little bit about what we want to cover off today. So firstly, Li Mei will provide an overview of the Pillar 2 rules. Then I will talk to or hand over to Kenneth, who will go through the systems implications, as well as a demo of the Oracle TRCS Pillar 2 module. Then Madhav will join us to talk a little bit about key differentiators from an implementation perspective and some of the approaches or best practices as well, before we have hopefully some time for a bit of Q&A as well. So let's start a little bit, if we move to the next slide, please, of an overview of the Pillar 2 rules. Next slide, please. Now this slide, while it's quite busy, provides quite a high-level snapshot of the upcoming implementation of the GloBE rules. And when I talk about the GloBE rules, I'm referring to the Income Inclusion Rule, otherwise known as IIR, and the Undertaxed Payment Rule, UTPR. And this looks at all around the world. If we drill down on Asia Pacific, there are a number of differences in terms of where everyone is at. You have countries that have enacted domestic legislation for IIR and UTPR, for example, South Korea, which will be effective from 1 January 2024. Some countries like Japan have drafted domestic legislation which is subject to approval by Parliament. Others have launched a public consultation of the GloBE implementation rules, and the examples there are Australia and New Zealand. And others have indicated their intention to introduce or implement the GloBE rules. So countries such as Singapore, Hong Kong, Malaysia, Indonesia, Thailand all fall within that bracket, and the implementation dates are likely to be between 2024 and 2025. If we look at Europe, in the UK, in Switzerland, and the EU, they've all indicated that the GloBE rules will be implemented from 2024. Now, the implementation date of the GloBE rules for the US is uncertain, although President Biden has indicated that the US champions GMT and will work to see it implemented. So we can see that the rules are creeping up to us from a go live for many countries. At this point, what I want to do is pass over to Lee May to provide an overall overview of the rules themselves. Now, Lee May, I know you as an international tax partner specializing in Pillar 2, you could speak for the whole hour. What I want to do is, this session is primarily focused on the technology discussion on Oracle, but it's worthwhile having the background context of some of the key concepts from Pillar 2. So perhaps, Lee May, I'll pass over to you.
Thank you, Piers, and good morning, good afternoon, everyone. And you are right, I'm not going to spend a lot of time. I promise not to take more than 15 minutes on this. So let me just do a quick recap of the Pillar 2 rules before Piers, Kenneth, and Madhav dive into the data requirements, as well as the challenges that come with it. So as you know, Pillar 2 sets out the global minimum tax rules, which have been designed to ensure that large multinational businesses pay a minimum effective rate of tax, right, the ETR, which has been agreed at 15% on profits in all countries. So this is regardless of where the MNEs operate or are headquartered. Now, the effective tax rate, or ETR, will be calculated on a jurisdiction by jurisdiction basis. And when the ETR, which is calculated based on the globe rules, in a jurisdiction is less than 15%, then the MNE would be required to top it up to 15%, right? So in the next slide, if we could please go to slide 6. Okay, so the Pillar 2 rules, sorry, in the next slide, please. The Pillar 2 rules apply to taxpayers that have a foreign presence, and that means that they must operate in at least 2 jurisdictions. And they have consolidated annual revenue of 750 million or more in at least 2 out of 4 fiscal years immediately preceding the tested fiscal year. So there are some exclusions. So for example, the globe rules does not apply to specified entities such as governmental entities, international organizations, and non-profit organizations and pension funds, right? Preserving domestic tax exemptions for sovereign, non-profit, and charitable entities, as well as any investment fund or real estate investment vehicle that is the ultimate parent entity, or the UPE, of the MNE group. So these entities, known as excluded entities, they are not excluded for purposes of determining the MNE group or whether the MNE group actually meets the revenue threshold for being in scope. So what this means is that their revenue will still be taken into account for purposes of determining the consolidated revenue test. The exclusion of the globe rules to an excluded entity doesn't extend to the MNE group that they control. And we also have the de minimis exclusion, which will apply on those jurisdictions where the MNE has globe revenues of less than 10 million euros and profits of less than 1 million euro, computed on a 3-year average. Now, if we move to the next slide, the globe rules comprise 2 interlocking rules, as what Piers has mentioned. First is an income inclusion rule, which is the main rule that imposes a top-up tax on the parent entity in respect of any low tax income. So when you have an ETR that's less than 15% in a jurisdiction. The other rule is the undertax payment rule, which will act as a backstop to the IIR. And how it will operate is that it would deny a deduction or require an equivalent adjustment to be made to the extent that the low tax income is not subject to tax under an IIR. There is also a switchover rule, which is part of the income inclusion rule, and it treats a branch or a permanent establishment in the same manner as a corporation. Now, in addition, there is also this treaty-based rule, subject to tax rule, or the STTR, that is intended to protect the rights of developing countries to tax certain base eroding payments. So examples are interest and royalties, to the extent that these are not taxed up to the minimum rate of 15%. So the STTR will reference a rate of 9% on gross payments, and it will be creditable as a covered tax under the globe rules. So the STTR is expected to be incorporated into bilateral tax treaties by countries that apply nominal corporate rate below that minimum rate, where it is requested by developing country members of the inclusive framework. So this model treaty provision to implement the STTR and the MLI, the multilateral instrument to facilitate the implementation of the STTR, are in progress. Now, finally, we have the Qualified Domestic Minimum Top-Up Tax, or QDMTT. It is a tax that's imposed under domestic tax law, and it operates to collect the top-up tax in respect of the low tax income in that jurisdiction. So this minimum tax can qualify as a QDMTT only if it is implemented and administered in a way that is consistent with the outcome as provided under the GLOBE rules. Okay, and that's provided the jurisdiction also does not provide any benefits that are related to such rules. The Pillar 2 rules have a status of common approach. What this means is that countries will not be required to adopt them into domestic law. But if they choose to do so, then implementation must be in a manner that is consistent with the GLOBE rules and the inclusive framework guidance. Now, let us have a look at what the ETR looks like in the next slide. So it looks deceptively simple, right? Just adjusted covered taxes divided by the net GLOBE income. And the difficult bit to this formula is really the data points that may be required. And Piers, Kenneth, and Madhav will talk a little bit more about this. So the ETR will be calculated on a jurisdiction by jurisdiction basis. So you will need to aggregate the adjusted covered tax and the net GLOBE income of all the constituent entities in that jurisdiction. And the calculation of the ETR is important as it will determine if a top-up tax may be paid. Now, if we move on to the next slide, if the ETR in a particular jurisdiction is then less than 15%, there will be a need to calculate the top-up tax. This is calculated by taking the difference between the minimum rate of 15% and the ETR that you have calculated for the jurisdiction. And this top-up percentage is then multiplied by the net GLOBE income of the constituent entities in the jurisdiction and deducting the substance-based income exclusion. So this is a certain percentage of payroll and tangible asset costs. So for tangible assets, initial years, it would be 8% markup on average carrying value, reducing to 5% over a 10-year transition period. And this covers both assets that are owned and leased. Whereas for payroll, it would be a 10% markup for in-country employees, reducing to 5%, again, over a 10-year transition period. And it includes both full-time employees and contractors considered under a multinational enterprise's supervision and control. So what this substance-based income exclusion does is it has an effect of reducing the amount of excess profits on which top-up tax percentage is applied on. And why is this important? Because your top-up tax percentage is unlikely to change. But if you are asset heavy or have many employees in a particular low tax jurisdiction, this could help manage the amount of top-up tax that is payable. And then lastly, adjustments will need to be made for additional top-up tax in respect of prior period, and a credit will be given for QDMTT that is being paid in that jurisdiction. Now, just moving on to the next slide on transitional CBCR safe harbors. These rules were released on 20th December 2022 based on public consultation which took place earlier in that year. And the transitional CBCR safe harbor rules is a short-term measure to exclude an MNE's operations in certain lower jurisdiction from the compliance obligation of preparing a full GLOBE calculations in the initial years. This is provided that the business can actually demonstrate based on qualifying CBCR and financial accounting data that either one of three tests are met. The first one, in that jurisdiction, the revenue and income is below the de minimis threshold. So this means that the business reports total revenues of less than euro 10 million and a profit before income tax of less than euro 1 million in its CBCR report for a country. The second test is a simplified ETR test. That simplified ETR must be equal to or exceed an agreed transition rate. So when you do the calculation of ETR by taking income tax expense divided by CBCR profit or loss before income tax, that number must be equal or greater to the transition rate. And the transition rate is 15% for financial years beginning 23 and 24, increasing to 16% in 25, and then 17% in 26. And the last test is what we call a routine profits test. And this test requires a business profits before income tax to be equal to or less than the substance-based income exclusion amount as calculated under the model rules. Okay. And where the transitional safe harbor rules apply, and any of these three tests are satisfied, then the top-up tax for that jurisdiction will be zero. Now, one point to highlight is the once out, always out approach. So if a MNE group does not apply the transitional safe harbor in a particular jurisdiction in 1 year, it cannot use the safe harbor for that jurisdiction in a subsequent year. So the exception is only if the MNE group did not have any constituent entities in that jurisdictions in a prior year. Permanent safe harbors, those are currently in development. So, in summary, Pillar 2 will impose new calculation and reporting obligations that require businesses to have appropriate systems and processes to identify, to gather, and to process required data. And we expect that, tax and accounting teams will then need to work together closely to scale up reporting and data analytics capabilities. So, Piers, back to you, please, on the steps to global implementation.
Thanks very much, Lee May, for that global view. And as you mentioned, let's talk a little bit more practical now in terms of what this means from a practice perspective. If we move to the next slide, please. So what this slide shows is a general overview of the steps companies need to go through in respect of meeting all of their obligations under Pillar 2. So if we move from left to right, and I'm going to put a timeline on these steps as well. So it all started with what we call the assessment phase, i.e., are you impacted? And this, for most companies, was done during the early part of 2022, maybe mid-2022. During the course of middle of 22 and sort of towards the end of 22, most companies were undertaking the second step, which is the data diagnostics point on the actual impact to them. So they were either utilizing tools to see what the actual impact may be in any particular market or on a global basis. Now, from the end of 22 towards where we're seeing companies are now, is they're really focusing on that third point, which is data collection. And Lee May picked up on a little bit before in terms of the data sets you're going to need for performing the calculation. So the data collection step is all about trying to understand the data sets required, where it sits, how it would be consolidated and mapped, etc. Then what we're going to see, and I suspect this will be towards the end of this year going into next year, the focus will be actually performing calculations. And the end goal, obviously, is the completion of compliance obligations. Now, this, for most countries in our region, will occur either in 25 or 26, depending on the jurisdiction. Okay. So that's just the general outline of the process itself. Before I move on, I think it might be time for a polling question, just to get some audience participation. So if we move to our first polling question, and the question is in analyze the impact of Pillar 2 for your organization, what do you see as the most administrative burden for you? And there are 5 options. The first one is data gathering, wrangling. Second one is financial reporting. Third one is computation. Compliance is the 4th option, and non-applicable, i.e. People think it just doesn't apply to them. So we're obviously seeing a number of votes coming through now, which I was kind of hoping to see these responses actually, because it's going to lead quite nicely onto my next slide. And it seems to be, from all the discussions I've been having with MNCs, the response we're getting now is pretty much consistent with some of the discussions I've had in Asia Pacific. We'll just wait a couple more seconds before we close the poll, but I think it's pretty clear from the 113 votes that we've had to date that there's an overwhelming concern or issues around data gathering and wrangling. So it is interesting results, and as I mentioned before, it's actually a nice segue into some of the challenges companies are facing in respect of their data. So if we move to the next slide, please. And this really addresses, and again, it's quite a busy slide, it really addresses the point from that polling question. From our experience talking to large MNCs, there can be north of 100 data points to collect per constituent entity, branch, or PE. Now, in most cases, this is going to sit in a wide range of systems or different departments within the organization. It's going to mean aggregating of accounting data from your ERP system, tax working files, and this could be group GAAP or could be local GAAP. Company data will be needed, and this will need to be aggregated, for example, ID information, employee numbers, ownership data, etc. So then the question really becomes, do you have the data at the level of detail you require? Coming to Flea May's point when you actually do the calculation. And more importantly, how are you going to design a data collection process that will give you efficiency and confidence in the overall process? So many companies at the moment, many companies I'm talking to in the region and my counterparts globally in our tax technology consulting practice, they are focusing a lot on data extraction. They are looking at data aggregation tools as well as data hubs with the appropriate mapping to ensure they meet all of these obligations in an efficient manner, because you have, as I mentioned before, so many different data sets sitting in so many different systems in so many different departments. So let's talk a little bit about the systems implications, I should say, and with a focus on Oracle TRCS. We're really pleased today to have Kenneth join us from Oracle. Kenneth, do you want to provide an overview on what Oracle is doing around Pillar 2?
Yes, Piers, thank you very much, and happy to be here and joining your conference. And let's talk about the system implications. But first, before we get into that, I just want to call your attention to Oracle's Safe Harbor rule. Today, we will be talking about functionality in the application that will be available in the future. And next slide. So what are the implications that you're thinking about? What are the challenges that you're considering and that you'll have to address as you go through the Pillar 2 implementation process? And I've broken them down into roughly 4 categories, specifically processing. We've certainly seen the data challenges and the data collection challenges. I've heard that there could be in excess of 200 data points required for Pillar 2. The calculation model is also of concern as well. And then last, compliance and specifically filing. When it comes to processing, our expectation is that you'll want to take a look at the planning or forecasting process and do a Pillar 2 calculation, determining whether or not there is a TopUp Tax liability associated with the new tax. the accounting process as well, of course, the filing process, but together with each of these processes, you'll want to be able to track the workflow or the task and manage the tasks associated with these processes. And then last, reporting and also certification as well. So the process is always a tremendous challenge for our customers. Typically, many times customers have to reconsider their process, and certainly they want to be able to track the workflow as well. From a data perspective, sourcing data from your tax work papers, from your tax returns, from your financial applications, that can be a very challenging process. So data collection can also be challenging if it's data collected throughout the world. And then many companies I've spoken to have talked about creating a warehouse of data for Pillar 2 specifically. And then last, of course, workflow around data collection and, of course, data integrity as well. So are you using data that you've used in other processes, specifically for accounting, for filing, for country level filing, for tax provisioning, for country by country reporting? You can see that there are some correlations between the safe harbor rules and the country by country report. Let's go on to our next topic, which is calculation and calculation model. Let's just stay back on the previous slide, please. So calculation and the calculation model for Pillar 2, a country level model, and then also safe harbor testing as well. And then last, filing requirements. So filing requirements within country. Are you going to file it XML, XBRL? For the specific domicile, is there a local filing as well? So filing and compliance is an important part of the process, and certainly one to be planned for as well. So a lot to do with respect to a new historic global tax regime. So let's go to the next slide. And today we're going to talk about how Tax Reporting Cloud, Oracle's tax reporting solution, will address the Pillar 2 challenges. And first, we have a slide which shows where our tax reporting solution sits in our comprehensive financial solution. In the middle of the screen here, you can see an enterprise data management solution that is used to manage all the metadata, the entities, and the accounts across all of the ERP and EPM cloud systems. Starting at the left, in the left box under ERP, you'll see the financials, fixed assets, and the indirect taxes are managed, supply chain as well. And then we move to the EPM cloud, where our planning and forecasting solution, our financial close, and our account reconciliation solutions are also managed. And tax reporting is part of the EPM cloud suite of solutions. So now tax reporting handles tax provision, country by country reporting, transfer pricing, as well as narrative reporting. Now, narrative reporting can be used across all EPM solutions as well. So across the top, as a rainbow to all of these solutions, we have complete self-service. Many of our customers, our tax reporting customers, use the application. They manage their metadata, their entities, their accounts within the tax team. And then, of course, the application is global, accessed through a browser, can be accessed on a pad or on your phone. There are collaboration points and an enhanced user experience. The solutions include dashboards and pixel perfect reporting for analytics. And then, of course, there's embedded intelligence, such as process intelligence, that you can kick off data loads in a lights out approach. And lastly, a secure system as well with Oracle Security. So let's go to the next slide and talk about what's included in tax reporting. So tax reporting includes, you can see across the bottom, for one price per user, all of the functionality listed below, tax provision, comprehensive tax provision in accordance with IFRS as well as US GAAP rules built specifically for a balance sheet approach, the country-by-country reporting, including dashboards and the XML filing, master and local file filing as well. And then, of course, in aspects of the
I think we may have lost Kenneth. He may have some issues. Is it me that just cannot hear Kenneth?
Me as well.
Yeah, me too.
While we wait for Kenneth to jump back on, I know hopefully he'll jump back on very soon. That we actually do have a polling question coming up next, and perhaps we move to that polling question. Yeah, there it is there. So this was one that before Kenneth launches into a more detailed deep dive on the actual system itself. The polling question is, in the current systems your current system landscape looks to be one of 5 options. You currently license Oracle Tax Reporting or an EPM suite and don't have any plan to implement yet or maybe later. 2, you're implementing or using Oracle Tax Reporting for tax provisioning and or CBCR. 3, you're preparing tax provisioning in Microsoft Excel and considering Oracle Tax Reporting. 4th option is you're using another solution for tax provisioning and considering Oracle Tax Reporting. Or the 4th option, or 5th option, I should say, is you're not considering Oracle Tax Reporting at all. So if we vote, Kenneth, are you back on?
No, not yet.
Wait for Kenneth to come back on. Got a few more results coming through, so there is it's quite a mix here of some people using tax provisioning in Microsoft Excel. Where have we seen that before? And that's quite prevalent amongst a lot of corporates, and they're considering using some form of technology, whether it be Oracle, whether it be SAP or other providers. The 4th one's interesting as well, using a solution for tax provisioning other than tax reporting. So that's linked to the 3rd option of they're considering some form of technology, whether it be in Excel, etc. I think we've got Kenneth back. No, we don't. For the stage, Kenneth is actually dialing in from the US, so we were hoping that we wouldn't have any issues with connection, etc. Well, perhaps in the interest of time, what we could do is before Kenneth manages to join us again to actually do a bit of a deep dive on the solution itself, maybe I'll pass over to you if we move forward a number of slides and talk a little bit about some of the issues clients are facing in terms of practical matters on implementation, and also, from a key partnership perspective, what are some of the key differentiators when we talk about implementers in terms of partnering with people such as Oracle or any other provider for that matter.
Yeah, thank you, Piers. Hello, everyone. Here, I would like to highlight, maybe can you go to the next slide? Here, I would like to highlight some of the key differentiators that Deloitte as an implementation partner would provide when implementing Oracle TRCS for tax reporting solution, including Pillar 2. Tax accounting or Pillar 2 knowledge alone proves insufficient to make tax reporting solution projects successful. You also require capabilities as seen in the slide to your left, including Pillar 2 knowledge, tax accounting knowledge, and IT knowledge. Deloitte has a proven track record in such implementations. Deloitte has with it tax technology consulting team, the largest global practice with over 2,500 plus tax technology professionals that focus on process and system implementations. In Asia Pacific, we have our tax technology consulting team embedded into our tax center, in which I am part of. This team consists of professionals with a unique background in both tax and IT. This combined knowledge creates the solid background that makes your project a success. And to your right, another key differentiator is Gartner, a leading research firm, indicated in its 2022 research on Oracle Cloud Application Services that Deloitte is recognized as a leader for Oracle Cloud Application Services. And in fact, Deloitte has retained this position as a leader for the 4th year in a row. All this leads to say that Deloitte has a proven track record in implementing Oracle TRCS. Next slide, please. Thank you. Here, I would like to let you know on the implementation approach that we would follow in implementing Oracle TRCS for tax reporting solutions. The implementation approach that we follow is called as fast track approach. With Deloitte's fast track approach for Oracle's tax reporting, you will have pre-built reports and navigation flows, so the implementation of the engine will go smooth and fast. It is a great starting point to automate your Pillar 2 calculations. Oracle TRCS is one of the few mature tax reporting solutions in the marketplace. Deloitte, with its functional knowledge of the process and content involved, turned this into a standard material that can be utilized in the implementation. Through this approach, we deploy market standard work papers, reports, and dashboards, and give clients valuable time back in such implementations. This enables clients to focus on solution adoption, and this ensures the success of the implementation. Also, Deloitte's fast track approach makes sure tax reporting is configured according to the best practices and lessons learned. We will take Oracle's functionality and apply Deloitte's best practices and turn this into a value for our customers. With our solution, your automated tax calculation is IFRS proof or US GAAP proof, depending on the accounting principle you follow. There will be no need for any lengthy design sessions as the best practices are already built in. Next slide, please. Lastly, here I would like to stress the need for integrating the tax accounting process with the Pillar 2 calculation. As we know, key data elements for Pillar 2 calculations are IFRS data or US GAAP data per jurisdiction and legal entity. Also, permanent and temporary differences per entity are required to assess whether these elements are part of the so-called globe income calculation, and that the related tax affected amounts, meaning the current and deferred taxes relating to these adjustments, are available to calculate the so-called covered taxes under Pillar 2. This means that the tax accounting data is a vital input for Pillar 2 calculations. Also, where Pillar 2 leads to the so-called top-up tax, where a current tax provision needs to be accounted for when preparing the tax accounting position. This means that the outcome of Pillar 2 calculations are used as an input again for the tax accounting process. We therefore strongly recommend that Pillar 2 calculation should be integrated with the tax accounting process for better results. Thank you. Over to you, Piers.
Thanks, Madhav. And I cannot stress that more enough in terms of provisioning. The more and more discussion we have with clients here in Asia Pacific and also globally is they're actually re-looking at how they do provisioning full stop, whether it be implementing new technology, whether it be amending templates, etc., in light of their Pillar 2 obligations and their reporting that they would need to do under provisioning. Now, we're going to take a step back now. We have Kenneth back on the line, and I do apologise to everyone that we lost Kenneth for a moment. So let's go back to the actual Oracle solution. And Kenneth, I know you'd provided a very brief summary, and I know now I think you were going to launch into some slides on some of the actual template solutions, etc.
That's right, Piers. Thank you very much. Sorry that I dropped. And I'd like to focus in on our roadmap for Pillar 2 at this time. And so in this slide on the left-hand side, I'm showing that we have broken down our development for 2023 into three parts of a phase 1. And so on the left-hand side, we have phase 1A, where we're developing our top-up tax model. And we'll be able to see those templates and web forms today in Snapshots. So the top-up tax model includes the globe income calculation, the ETR reconciliation as well, and covered tax expense calculation, as well as the top-up tax calculation. So with that, we'll be releasing forms, dashboards, and reports. Now, some of the other considerations in phase 1B, including the safe harbor rules, and then 1C, including country level modifications and the IIR and UTPR. They will follow later this year. In terms of timing of release of the top-up tax model, we have a customer preview going out in May 2023. And then a generally available to release to follow before the end of calendar year Q3. So that would be September. So once again, the top-up tax model, the basic model by the OECD, will have a customer preview. So if you license the solution, you'll have access with a regular monthly update in May, and then the GA version to follow in on or before September's release. So let's go to the next slide. And let's take a look at some of the snapshots and web forms included in the application. Our tax reporting solution uses automation to be able to move data within the solution. So to the extent that you want to move data into the globe income calculation, you'll be able to use this automation screen to move that data, for instance, into the globe income form and or the covered tax form. So as we've noted already, a number of the data points are already included in the application by virtue of the fact that you're performing the provision calculation in the application, and you're also storing your country by country reporting data in the application. So that data can be pulled directly into the Pillar 2 calculation. For instance, the net income per book can be pulled from the trial balance that's stored in the application, and the income tax tax expense per book can also be pulled as well. So just as an example, you have these simplified automation rules. They are inherent within our application to automate data, to create efficiency. You could think of them as just as a modified cell rule in Excel, and that moves data through our application. So let's go to the next slide. And so we have a template for globe income. Across the top, you'll see our point of view. In this example, we have the scenario is the actual scenario. The year is fiscal year 2022, P12. And you'll see that our entity is Vision Singapore Operations. This is one entity in Singapore. We, in fact, in this example, have two entities, a Vision Singapore entity that we'll see a little later in the template. We also capture the currency, the consolidation, the jurisdiction. The jurisdiction is key to capturing the country level, and then also the multi-GAAP. So in this case, we're exposing the local GAAP. So the globe income, there is an automated column where we're automating data. For instance, the net income per books into the automated column. And then we're also automating the income tax expense as well. In this form, you can make adjustments to these automated amounts. And those adjustments can be manual. They could be uploaded into the application through using our Excel add-in. And you can modify those calculated amounts as well. A list of adjustments are included in this form. These are primarily prescribed adjustments from the OECD, and down towards the bottom you have elections as well. So this form will calculate total globe income, and that'll be used in the ETR calculation. Next slide, please. So the covered tax expense is broken up into several different pieces, include current tax expense, current tax charge as per book, the deferred tax amount as well, and then other adjustments. In this template, you can see that we're pulling in the
I think we've unfortunately lost Kenneth again, but what he was going to go through was how the information is pulled in to the system, straight into the templates that have been created within Oracle itself. So here you have a tax expense line. Now, Kenneth, I think you're back.
I am sorry about that. Can we go to the next slide? And now this is the deferred tax reconciliation for covered tax. What I want to point out is that we're pulling in the tax effects for the deferred tax current year movements, and we're pulling in the tax effect at the current year rate. And I just want to point you to the recasted adjustment down at the bottom. So what we're doing is we're pulling in the tax at 25%, and then we're recasting down to 15%. You can see the negative adjustment here in the form. Let's go to the last slide. And now here we're pulling together all the totals. We're pulling together the current tax, deferred tax, and then any other adjustments. And you can see the 117 million. Let's go to the ETR calculation in the next slide. Okay, so for Vision Singapore operations, we had 1.2 billion in globe income, 117 million in total covered tax. For an ETR for this entity, so you'll be able to see the entity ETR of 9.77%. So let's go to the next slide. And let's take a look at the top-up tax calculation for this company. And so now we're pulling in the globe income adjusted for substance-based income exclusion for payroll and intangibles. And we're also calculating and showing the Pillar 2 rate versus the ETR. So 15% minus the 9.7 gives you the 5.23% and the calculated top-up tax value. So let's go on to the next slide. Okay, so now we want to aggregate all the companies in Singapore together. And you can see that we have total Singapore. We have two entities, Vision Singapore and Vision Singapore Operations. The effective tax rate for the combined aggregated entities is 14.15%. And let's go to the next slide. And we would expect a top-up tax of 0.85%, 15% minus 14.15. And here we calculate the top-up tax on the globe income as adjusted for the aggregated entities. So this model will be available in May for customers to look at on a preview basis. and will be GA later in the year. With our September, at the latest, with our September release. So PSI, that's our presentation on our top-up tax model, and I'll turn it back to you.
Thanks very much, Kenneth. And it's really interesting insights on what Oracle has in place in respect to Pillar 2 reporting. So just to summarize, Madhav earlier talked a little bit about how we work with we in Deloitte work with Oracle on implementations and some of the key takeaways on a successful implementation. I don't want to go through all of that material again, but what I do want to say is that we do have teams across Asia Pacific who can support on anything that you might be doing in relation to the Oracle Pillar 2 reporting. And we really do look forward to the upcoming updates in May, Kenneth, in terms of seeing what you have in place, because I mean, what you've shown us to date, to be honest, is very exciting as well. So that just about concludes today's presentation. But before we do have some time for some Q&A, and there have been a couple of questions that have popped up into our Q&A board, and I might cover off some of them right now. So the first one, and Lee May, I might pass this to you. There was a question around the domestic qualified or the minimum top-up tax, and the question was essentially, is the qualified domestic minimum top-up tax include companies enjoying tax incentives, say for example 0% in any year?
Thanks, Piers. I think the expectation is that the QDMTT will be aligned to the globe rules. So this QDMTT will then apply to companies that are part of an MNE group subject to those rules. So that's point number one. So that would mean that, if ETR in that jurisdiction is less than 15%, because, for example, the tax incentive that was mentioned, 0%, right? Then there will be a top-up tax that will be payable in the jurisdiction. And what the QDMTT does is really taking the first bite out of the cherry. So if you do have a QDMTT in place, what that means is that that jurisdiction will then be able to collect the tax up to 15%. So it doesn't quite change the fact that a top-up tax would need to be paid for MNE groups that are subject to the globe rules. It's just where those top-up tax needs to be paid. So if you have a QDMTT in place, that's going to be paid in the low tax jurisdiction. If there is no QDMTT in place in that low tax income jurisdiction, then the top-up tax will be paid in the jurisdiction of the ultimate parent entity to the extent that it has adopted the IIR.
Thanks, Lima. A couple of other questions that have come through separate chat groups as well. Maybe Kenneth, this is one for you. Similar to the tax automation rules, can you have similar rules per a single global income and covered tax accounts?
Sorry, can you repeat that one more time? Sorry.
So similar to the tax automation rules, can you have similar rules per single global income and covered tax accounts?
Yes. So the tax automation that we're releasing is going to have global rules, domicile rules, and entity rules, similar to the tax automation that is included in our provision calculation, and it will be as robust as that process.
Okay, great. And here's another one. I'm going to hand over to you again, Kenneth. I think you're best on this one. It's quite a detailed question, so I'll read it very slowly. For deferred tax, the Pillar 2 rules may have different definitions compared to the accounting rules. For example, unrecognized deferred tax assets for losses needs to be reflected in for Pillar 2 purposes. Also, we need to recast the deferred tax amount, and recapture rules may also apply. What is the best practice to recast the amount and store and carry forward the recast data?
Yeah, I mean, that's a great question. I think we scratched the surface on that within the past couple of weeks, identifying NOLs and losses as being part of the Pillar 2 calculation, similarly treated as temporary differences. And then to the extent that we need to track the deferred tax, we do have the deferred tax roll forward within the application. We also have tax loss carry forward schedules as well. We just started to scratch the surface on the recapture rules.
Great.
Great question. We're on it. And I just want to note, Pia said, all the work that we've done has been together with Deloitte to create the model, and the work that we're doing ongoing is to expand that model and be able to address all the unique requirements of Pillar 2.
Right. I think there's another one. Again, hate to bombard you with questions, Kenneth. It's another question that's come through about dual systems. So is the Pillar 2 module in Oracle applicable if the ERP is not Oracle Cloud and tax provisioning is using another software?
Absolutely. We are talking to customers who want to use the Pillar 2 alone, just the Pillar 2 model. Can be used together with any other ERP as well as any other tax solution. You could be doing your provision in Excel or another solution and use our Pillar 2 model. Right. So we're already talking to customers today together with Deloitte.
Thanks, Kenneth. Now, I'll throw another one maybe to Lee May this time. Are MNCs applying the Pillar 2 rules in 2023?
Yeah, yes, I think that's a little bit more about MNCs trying to get a feel, of the data that, they need to collate, what sort of data they need to collate, where can they find it, is it hard to find, all of those. So we do have MNCs actually using 2022 data even to do a simulation of a preliminary impact assessment so that they know, what are the data points to collect, how it all fits into the calculation, and what are the results that come out. And based on the results, then, these businesses actually looked into what is driving that low ETR calculated based on globe rules. And then they can ascertain, whether or not there could be something that can be done around that.
Yeah, and just to add on that, we've actually been talking to a number of clients who are going through the issues around data collection, all that sort of stuff, and they're looking to do a dummy run for FY23 right now. So the short answer to the question about is, does MNCs applying the Pillar 2 rule? It's not so much applying the Pillar 2 rule, it's more about using 2022 data in 23 as a test case scenario to be ready or see what might be missing as their planning goes for 24 and 25. Okay. We do actually have some other questions, but unfortunately we have actually run out of time, and we will specifically answer those questions separately via email as well. So as I mentioned before, we have run out of time. So Lee May, Madhav and Kenneth, I really do want to thank you for participating, and a special thanks to all of you who've been able to join us today as well. We would encourage you to fill out a short survey that will pop up on your screen momentarily to tell us what you think about today's program. I again do apologize for some of the tech issues we had, but we got there in the end. If you joined late, please note that this presentation will be archived for future viewing. If you feel others would benefit from the webcast, please share the webcast via the share this icon, or have them visit the Dbriefs website itself. We will, as I mentioned before, respond to all of the questions submitted during the webcast in the next week or so. Also, if you think of any other questions or have any other comments later, feel free to reach out to either myself or any of our speakers. We'll be happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Indirect Tax series, and that'll be happening on the 13th of April, and it's titled Export Controls, Regional Updates, How to Deal with Transfer of Intangibles. And lastly, from all of us at Deloitte, thank you very much for your participation in Deloitte's Asia Pacific Tax webcast today. I wish you a farewell.